We witnessed another fiery presidential debate last night, we'll call it. But as we draw closer and closer to Election Day, America continues to ponder how the policies of each of these candidates will impact their wallets. So here to talk about that and other important financial questions is Ohio's retirement coach, Greg Taylor, president of Legacy Retirement Group. Hi, Greg.
Hi.
Happy Monday.
Yes, Columbus Day, and you're right. I get all these things in my mailbox telling me how wonderful the sales are today.
Exactly. That's about all we get out of today, right? So we're going to help answer people's questions. This is what you do, the Ask the Coach segment for us. So this person wonders, once this new administration is in place, there will inevitably be policy changes, right? Is there anything we should do in advance to protect our assets?
Well, I think there really is, because even though one of the candidates is proposing major tax cuts and another one's telling us that they're going to raise taxes, at the end of the day, we have a lot of debt in this country. So I think one of the major things people need to start planning for is how to plan for future taxes.
Okay.
You really need to start being smart about how you plan. Not just defer your tax till later, but start thinking about tax-free strategies. That's going to be so important. And then having a good, solid investment plan is going to be key.
There aren't a lot of people who have pensions anymore, right? Those are kind of like hit or miss depending on what company you work with. But now some people want to know, how should I take my pension? That's our second question. Lump sum, monthly payments, you get those two options. So What do you pick?
You know, even people who have had pensions for years are getting these pension buyout options. Several companies that are in the area have begun to do that. And in fact, I just got a check last week that I didn't even know was coming, because they decided they didn't want to offer the pension anymore. So if you have the choice, you have to really do the math. So, and we love helping people do that, is figure out, should I take the lump sum payment or should I take the monthly income? Now, the lump sum, what's nice about that is you do have control of the money.
Right.
But you have to be really careful. You don't want to go off, paying off your house or buying, luxury cars, or even not a luxury car, but taking a bunch of money out where you have to pay a bunch of tax, and then you don't have that money there for future income.
Right. And the monthly, if you do take it monthly, doesn't it stop when you pass away?
It can, or you can leave, a certain amount to your spouse, but when you're both gone, then there's nothing left to the children or any heirs.
Okay. All right, Greg, next question. How should I invest during retirement? Then maybe if this person has this lump sum, right? Where do they put it?
Well, I like to say this, not the same way you invested when you were 20.
Okay.
So, and what I mean by that, when you're 20, you just start putting money into something that's solid, maybe some mutual funds, maybe you put it just into the company 401k, that kind of thing, and you just sort of dollar cost average in, and you don't really have to even worry about it. But if you're over 50 or 55, you really have, excuse me, you really have to start thinking about, what if you have to start taking money out? And what's the impact of that in an up and down market? So when you do that, you have to really use more of a tactical approach, where sometimes we're going to follow where the strengths are. So it's stocks, bonds, real estate, and commodities. And sometimes real estate and commodities are a good place to be, and stocks and bonds really aren't. Other times it's bonds and maybe some real estate and not stocks and commodities. So we have to have a system that gets us into places we need to be, or that are most likely to help us succeed without taking big risks.
All right, Greg, the other thing that we know will happen, aside from taxes going up, is inflation.
Yes.
So how do you calculate that into your retirement plan?
Well, it's really hard, because the last few years we've not really had the same type of inflation rates that we had seen in maybe the previous decade. But if you factor a 2% increase per year for inflation, then over a 10-year period, that's a 20% increase in your overall expenses.
Right.
In a 20-year period, that's a 40% increase. So if your budget is, $5,000 today for a month, then in 10 years it's going to need to be at least $6,000.
Right.
So think of it like that.
Yeah, definitely important to put into perspective. Okay, and if you have retirement questions for Greg, you can ask him yourself. Questions at ohiosretirementcoach.com is the email address, and he would love to be able to answer your question right here next Monday. Well, from surfing and skydiving to marathons and mountain biking, if we know anything about baby boomers, it's that they are not slowing down. Greg is sticking around after the break.